Buddy, it's Brian Shannon from AlphaTrends.net. Today is Friday, the 27th of July, 2018. Let's look at this market here. The S&P 500 actually was positive this week, as were the semiconductors, the Dow, oil, financial stocks, and energy names. But the Nasdaq and the Russell 2000 were the most notable losers here. So let's take a look at the charts and see if we can make some sense of it. The S&P 500 on the daily time frame, as we know, earlier in the week we broke beyond this resistance and seemed to be definitively so. But we did see some pullback here, and we are now right at a level where resistance broken tends to act as support. And now we're going to see if that does, in fact, hold true next week. The shorter term, intermediate term time frame, we did close below the 5-day moving average, so that puts us on a little bit of a cautious tone. And it's encouraging, however, that the volume weighted average price from the beginning of the most recent rally still holds. In fact, it was the first test of that. The volume weighted average price from that level still held on a closing basis. So, halfway through the breakout here from earlier in the month, we're still holding above that volume weighted average price. So we're still in a primary uptrend. That clearly has not changed. The weekly time frame, it looks like it's still likely to head towards new all-time highs, but seems as though we just got a little bit derailed here this week, and we're going to see that next week we want we want that volume-weighted average price off the beginning of this move to hold, and we can draw a trend line in here as well that would look something like this, and we're pretty much right on that as well. So the market going into next week, a little bit rocky here. We obviously lost ground from some big tech names, and that brought the Nasdaq down to the volume weighted average price from the low of the recent move. We had been holding the volume weighted average price from that breakout level beyond this little inverted head and shoulders pattern we've spoken about in previous weeks, and that had been holding. That's where we had seen the buyers. Well, that failed today, and we dropped down to the next level. So this area in here, when we let's take a look at a 130-minute time frame, and on here I simply have a 50-day moving average and a 5-day moving average. And the what was I going with this was the prior resistance is being tested in here as well. We are again above the rising 50-day moving average. We're above the rising 20-day moving average. So again, there's that volume weighted average price off the recent low, and it seems as though we're now in a position where if this is a failed breakout, we'll know. But again, with the primary trend still in an uptrend, it might mean we just need a little bit more time to digest these gains. Russell 2000 was pretty disappointing. It seemed as though it was ready to break out beyond this little cup and handle here, this being the cup and this being the handle in there. Instead, it failed to break out. We saw that it got back below that 5-day moving average, and the 5-day moving average was declining Tuesday through Friday, giving us reason not to trust this market. But today's sell-off was a little bit steeper than what I would have expected. We broke through this 166 level, and now we're going to be looking at this prior support as potential resistance into next week at 160, even up to about 166.75, 167. If we can't get above that, then perhaps this market will experience a deeper sell-off. So definitely something a reason for a little bit of caution. Semiconductors, I just continue to think that they're a little bit of a mess in here. They are consolidating really, in a range that is tightening. So, if they continue to trade in this triangle, that's fine. But right now, I don't see an advantage to getting involved there. The financials, as we know, they sucked in short sellers on these new on this new low over here, and then on this new low. They've gotten squeezed. We're heading up towards the top end of the recent range. We're at a trend line, and we're right at the year-to-date volume-weighted average price. In order to trust these banks for a breakout of this range, I think we need to see it run up to that level, spend some time under it to build some energy to be able to hopefully sustain some upside and find a group that can lead this market. It certainly, as we know, wasn't technology this week. Facebook was, one of the most notable ones. This one broke below its year-to-date volume-weighted average price, as well as the volume-weighted average price from that April low. This stock is going to need time to heal. And, if we look at the volume-weighted average price since the event, the last 2 days, we're still, on average have sellers in there, similar to what we saw with Netflix. That Netflix, when they gapped lower last week, the buyers came in, initially, and we got that bounce. But with that declining 5-day moving average, we knew not to trust it, and we've seen that the volume weighted average price from that event, the earnings gap lower, that the sellers are coming in when it gets up to that average price, telling me that we have sell orders from some kind of institution saying sell the stock at an average price, sell it maybe over the next month. And when it gets up towards that level, those orders get executed in the market because the broker is trying to do at least as good as what the average price has been since that event. So Netflix is a broken stock. It's going to need some time to heal. Perhaps it comes down towards 335. We saw Twitter today pretty much close dead on its year-to-date volume-weighted average price. If when you look at it on the daily time frame, it's a little bit difficult to see. So the shorter time frame that you can get down to. So, for instance, if we take a look at a 130-minute chart, meaning there's 3 candles per day, you can see that that price is 33.87. We saw a low of 33.90 and pretty much closed, just above that level here. So maybe Twitter begins to find some support in this area, but it's not a buy in my opinion, not when we have this momentum still so strong to the downside. If you're looking for a bounce trade, maybe you get a little bit of a bounce, but I don't think you're going to see that this type of sell-off just turns into an uptrend and that we're back at new highs anytime soon. So these are the dangers of earnings season. These are the dangers that we deal with in each and every stock. We saw that Amazon reported, and initially it broke out to a new all-time high, but had a negative close here. And Amazon probably needs to settle down in here a little bit, maybe even pull back. But the risks seem to be getting a little bit higher in this market. So listen to the message of the market and adjust your risk, meaning your position sizes and your stops according to what the market tells you for the time frame that you're engaged. I talk about an intermediate term time frame. That has to translate to whatever your time frame is for you personally. Thanks for tuning in and have a good weekend.